Okay, well, welcome everyone to the COVID-19 update with National REIA. I'm Ryan Coleman, president of National REIA. Today, we're going to be giving you guys some updates on any type of legislation for small business loans, administration, and PPP with Charles Tassel. That'll be at the end of our call. But first, we're going to be hearing after a few other announcements from David Lockard. He's the Senior Vice President of CBRE, so he's our special guest today. Welcome, Dave. And with that, I'm going to turn this over to our Executive Director, Rebecca McLean.
Thanks so much, Ryan. I want to give a special thank you for our broadcast sponsors, Home Depot Pro. We thank them for their support, both with the broadcast and with the special programs that they have for National REIA. They have special programs for investors that were developed for our members specifically, including 20% off paint right there in store at the register, rebates on your purchases, and other National REIA exclusive programs, including a cabinet and appliance program. So if you're a member of a National REIA affiliate or chapter, then you are eligible for those programs. Thank you to our other sponsors as well: Arcana, Rent Perfect, Equity, IDI, Office Depot, REI Pro, and Foreclosures.com. And a special thank you to those who participated in our trade show yesterday: Apartment Mentors, Credit Sense, REL Academy, Note School, Tony Young's, and Pete Young's. Our mission at National REIA is to promote, to protect, and educate. And we've been doing that since 1985 with about 120 local chapters and affiliates to be able to serve over 40,000 members. And we want to thank you for your membership in your local REIA, which also includes a membership at the National REIA. Thank you for your support and for being with us during these times. If you aren't a member, we want to let you know that you can find your local group right on nationalreia.org. Just click on this Find a Local Group button here. And during this time, you'll also be able to find any COVID updates by pressing on the COVID-19 update button. So you'll be able to see any of the things that might be affecting you and your business on that page. Just a quick disclaimer: any of the information we give today is just a presentation and for educational and informational purposes only. You won't be hearing from any attorney or CFP or CPA. So if you have questions in terms of investing, you can talk to those professionals in the areas where you need them, and see your local REIA for any local information in terms of laws. But we will now turn it over to the expert in terms of what's happening around the country with CBRE. Dave Lockard, thank you so much for being with us today. He has done many presentations for the national group in the past in terms of kind of national trends, what's happening, and is very, very active in the local apartment associations where he does business. Dave, I'm going to let you share screen and take it away.
Thank you, Rebecca. Let me go to share screen. Can everyone see my screen?
Not yet, Dave.
Okay. Excuse me. All right.
Dave, when you hit the share screen button at the bottom, it'll open up a box and it will show you what's on your desktop, and you have to click on your PowerPoint presentation and then open it up on your desktop.
Yeah, I made a one participant can share at a time, multiple participants.
Do you see the share screen button at the bottom?
Actually, it's
you got to hover your mouse over the bottom of your computer.
Share. Okay.
Yep, hit share screen.
There you go. Perfect.
There we go.
Thank you, sir.
Okay, very good. Sorry for the technical difficulties. Can everyone see me now?
We can. Thank you.
Okay, very good. Good afternoon, everyone. Thank you to Rebecca, Ryan, and the National REIA for inviting me to present a national macro overview, or a second quarter overview, if you will, and also gauging the impact of the COVID-19 on the national multifamily market. So Rebecca and Ryan gave the introduction, a little more background about myself. I'm with CBRE in Cincinnati, based in Cincinnati, Ohio. Have about 30 years in the multifamily business, the last 24 as an investment sale broker focused entirely on multifamily. I'm work under the CBRE Inc. umbrella. I mention that because we're a global firm, actually a Fortune 120 company. Because of that, we have access to an incredible amount of information, resources, and research. Frankly, our research pipeline, some days it feels like if you go to the drinking fountain, you get a fire hydrant unloading on you because there's so much information coming to us. Important though, but we're able to distill this information. So I gathered up a fair amount of this to try to give us a little bit of a level set today as to what's been going on in the multifamily market in the first 6 months of this year. I don't know if we'll get into a little bit of forecast and conjecture, although I will tell you that the forecast and conjecture, they change about, well, daily. So with that said, pre-COVID, what did the market look like? Well, here's some perspective on pre-COVID fundamentals in terms of vacancy, year-over-year rent growth, going back to 2005. So if you can follow this, you'll see that you had, except with the exception of 2009, 2010, we had fairly steady rent growth, coming out of this recovery. We also had, diminishing vacancy. We had climbing rents for the last 9 years. So the market fundamentals in this latest recovery cycle had been, I would describe them in a word, fabulous. And I think many of you would agree when we came out of the Great Recession, we've been on an onward and upward escalator. Now, vacancy coming into this year was at a 25-year low over the longitudinal average. If you look, at the high point of vacancy nationally, and these are national numbers, we got into that in excess of 7% vacancy. Latest, we're, 7% vacancy. And, today, we've been operating in that 4-ish range. So market fundamentals nationally, market, supply demand fundamentals were very strong and very favorable. We also saw, and that's even in light of growth in the rental stock. The green line you can see on the chart shows that the percentage growth in rental stock had been growing anywhere from 1% to 0.5% to almost 2% growth in a given year over the last 10. So all indicators and signs of a healthy market. Then let's say we had, I like to call it the excitement appeared in March. And I don't have to tell you that the world changed almost on a dime. And this will give you one indicator is the unemployment rate. It shot up dramatically as we had shutdowns across the country on an unprecedented scale. It's a word we've been using on my team a lot in the past 90 days, unprecedented, that we haven't experienced in such a long time. So I would tell you that this COVID-19 shock took a lot of air out of balloon and burst the bubble a little bit in the multifamily market nationally. And what happened in 2020, spring did not turn into summer. Spring turned into winter. We had an initial shock. We experienced a freeze in activity, both rental activity and sale activity. We also have experienced in the rental market continued deterioration and also in economic fundamentals, but these have moderated somewhat. The metrics that we're looking at going forward to gauge the health of the market, in addition to supply and demand, we are looking closely at rental collections. I would tell you, and by the way, I will supplement some of this national data from research with anecdotal evidence from my Midwestern peers. Every week since the COVID shock arrived, 30 of my peers in the Midwest at CBRE across the country, we hold a weekly update call. And that update call covers a lot of different points. One is, what's rent collection been like in your market? What's been the impact on vacancy in your market? What is leasing momentum? What's happening in the sale market? Where is your market feeling stress or less stress? Have there been any changes in the development pipeline? So I'm going to sprinkle in some of those data points and vignettes over the next few minutes to give you some perspective. Back in March, at the end of March, when the initial COVID shock struck the country, there was a lot of discussion amongst our clients, and some of these were fairly large holders and owners of multifamily properties with portfolios of 20, 30, 50,000 units. They started to, with the magnitude and scope of the shutdown, they started to stress test their portfolios. They played what if on a macro level. What happens if April collections, if our bad debt, which historically have been 1 point, okay, what if it turns into 10? What if it turns into 15? What if it turns into 20? And what if that goes on for 6 months? So those are some of the calculations that were being run through at the end of March. I would tell you, as we sit on June 19th, that April, May, and June have been, compared to the expectation at the end of March, those have been, generally speaking, pleasant surprises just from a landlord and collection standpoint. Most of our larger clients, they have experienced higher than normal bad debt or economic vacancy, but it hasn't been in that 10% range. It's been in that 2% range and 3% range. So we haven't felt, at least from a large landlord standpoint, a massive hit. And a number of reasons. Certainly, the various, you put $1 trillion of stimulus into the market, and unemployment benefits and different subsidies that have, governmental actions that have taken place to try to bolster the housing situation. And I would say, by and large, at least at this point, those have achieved what their goals were, at least in terms of keeping people in shelter and under roof and keeping apartment landlords reasonably solvent at this point. Now that we've got through April, May, and June, now the question is, what are July, August, and September look like? So we've covered that hurdle of the second quarter. Now the focus is going forward. What will the third quarter look like when a lot of unemployment benefits run out? So that's the speculation amongst landlords at this point across the country. And not all the stress has been felt at the same levels across all product types, all markets, et cetera. So this slide is a distillation of what's been going on where they're, across various product types and classes of property. So where we're feeling less stress, Class A collections have held up in the second quarter pretty well. Class C, we've had, fairly much, we have had a fair amount of effective rent loss. Now, conversely, in Class C, collection issues, Class A, inability to pass on any rent increases and more move-outs. On newer properties, okay, stabilized assets are, they've pretty much been able to sail through this stormy weather. Properties in lease-up, however, have seen a dramatically slower absorption, and that is creating challenges for properties in lease-up. In fact, they're having to, concessions and incentives, those have skyrocketed. There's a couple other areas that are feeling stress and have some exposure. If you had a portfolio with short-term rental and corporate units, okay, those have all pretty much, those leases and those packages, they've all been terminated. They've all done their exits. And so properties that, lived on high volumes of corporate units and short-term rentals, they experienced dramatic increases in vacancy. And then different metros have felt this differently. If you had durable industries, with tech and manufacturing and business and professional, you held in there pretty well. If you were specialized in that tourism and hospitality, for instance, I mean, it's been a bloodbath in Las Vegas, for instance, in terms of impact on the rental market. Those markets are feeling a lot of stress. And from a geographic standpoint, the high-flying markets, and this is held true in the last several recessions that we've had, going back 30 years. The high flyers, and think about this, the high-flying markets, high growth, a lot of velocity. Think of them as a high-speed engine. Well, when you throw a wrench into the engine, the damage is going to be a little higher than a slower moving engine, and our steady, I shouldn't say slower, more steady engine. So the high flyers, and we can signal some of those are the markets with high growth and population growth, high deliveries on new construction. Those markets have felt a lot more stress. And then the urban deals are feeling a lot more stress as well because of higher density. And people in the COVID environment now, there's been a little bit of, and I can't quantify it, but movement from urban to suburban. This grid, okay, this is courtesy of CBRE research and also relying on some axiometrics data. This gives you an idea of the markets where, to the left, rents are stable or, believe it or not, increasing, and then rents that are down slightly. And as we move to the right, you see the markets that are feeling more pain, there's higher rent decreases. So some of these high-flying markets in the San Francisco, LA, Seattle, Phoenix, Orlando, they've all been high growth markets. They're feeling, the impact of rental decreases. As we like to say in the Midwest, the flyover states, as we refer to ourselves, we aren't doing so badly these days. The steady eddies have held in there pretty well. And that's consistent with how they performed the last 30 years. So the rocket ships that have taken off over the last 10 years are, their decrease is more notable. And, it's the tortoise and the hare. I mean, we'll all end up at the same place, but the tortoise market's plodding along, Cincinnati, Detroit, Louisville, Minneapolis, Columbus, St. Louis, they're moving along at a more measured pace and have been able to withstand some of the shocks. Now, the May employment numbers, they show we're starting to see a little bit of return to work. So where you see April, the lighter green bars, that showed losses in various trades, okay? The darker green bars show May, you start to see some positive month-over-month payroll change. So you are seeing people coming back to work. Look at the green bar in the middle, though, that has dark and light green. Local government. As you can imagine, when people aren't going to work, okay, they aren't paying payroll taxes, income taxes, sales taxes. I would tell you that over the next year or two, local governments are going to be in a very difficult situation to try to make up some of this shortfall. Not only local governments, but local school boards. So you'll investing in markets now. I've talked to investors over the past month as they look at locations. They're also getting a feel for what's the economic environment of the local government, what kind of shortfalls are they facing, and also what are the school boards doing, what kind of shape are they in. One area I didn't mention when I was talking about product categories under stress. The big one that we're going to be watching in September is student housing. So I think everyone agree, in addition to getting everyone back to work, it's incumbent that we get kids back into school in some fashion. And we're all hopeful that's going to occur. The perceived risk, however, in student housing, the watchword there is caution, because what the worst case scenario is universities open in August and September, they have COVID outbreaks and close their doors again at the end of October or something to that effect. That's the biggest risk in student housing, or housing in general at this point. So CBRE, this is not my forecast, by the way. We employ economists and PhDs to dream this stuff up, okay? But here are 4 scenarios in terms of a recovery. So there's all this discussion of the V-shaped recovery, the W-shaped recovery, the swoosh recovery. So there are 4 potential scenarios on US GDP. And 2 of those scenarios, get us back to where we were in 2023. But I would tell you that it's going to be a little bit of a longer haul. The damage that's been wrought upon us is going to take at least a couple of years to resolve itself. So what are the demand drivers, the macro drivers of apartment demand? Population growth is one, okay? The other is household formation. And as you can see, we've had a significant drop on the left in household formation in the past year. So that's something we're watching closely. And the population growth rate is also slowing. So from a macro level, national level, the country's not growing at the same clip. The right-hand slide, this is real personal income. The chart shows to get back to where we were at the beginning of this year, CBRE's econometrics, their forecast, it's going to take 2 years to get back to where we were in terms of real personal income in the US. So the forecast here is the recovery occurs in the first half of 2022. So we're looking at really a 2-year window. And forecasts, estimates, they're all projections. But I would tell you that real estate in many ways is a get rich slow scheme. So it was described to me by a very savvy investor. And it's just, you have to have a longer term view and approach here for multifamily. That said, here's the predominant sentiment in terms of real estate investment. First of all, there is a tremendous amount of liquidity still seeking a home and seeking yield. The second piece is there is really a definite seeking out of or search for hard assets, fixed assets, which by the way are great inflation hedges. And in the real estate space, and I'm not going to opine on too many other categories, but there's a lot of, well, first of all, the hotel world is not going so great right now, okay? And it's probably not going to go great for a little while. Retail, there's a lot of questions in retail as to what the world of retail is going to look like, in the COVID era or post-COVID, because there have been dramatic changes in terms of retailers that have just gone out and just won't be coming back. So that the outlooks in hospitality and retail are certainly questionable. Office space, a lot of discussion about work from home. And what does that mean? Will offices be dark and never to be used again? I would say, and I have a lot of support in this, that the office is not dead. You know, we've actually been working from home in some fashion since the BlackBerry was invented. Now, you might see more optionality. You might see companies taking a little less space, but you're also going to see a trend where employers in office spaces, they had started over the last 10 years, especially, it started to cram more people and more people into smaller and smaller spaces. They're going to have to spread their wings. They can no longer pile people on top of each other. So I think you're going to see there's more discussion too about in some of the major metros, especially the ones that rely heavily on mass transportation. In Chicago, for example, or New York, Boston, where people are going to get into, light rail or get into the subway with a million other people. You're starting to see employers look at a hub and spoke arrangement. So rather than having 3,000 employees in a downtown central office, they might have 300 employees downtown and then have spoke operations in suburban office spaces to cut down on the commute, the hour commute, jammed into the subway. So that's a trend that you will see potentially in office. Setting those aside, the two darlings, the bells of the ball, probably for the next 5 to 7 to 10 years, are going to be industrial / logistics. I mean, that's no secret that is going gangbusters, and people can click it and buy it and magically appears. Well, there's a lot behind that to make that happen. And what's occurring is there's a lot of demand for industrial shipping and logistics. And then the second, and probably ahead of logistics though, is multifamily housing. People need shelter. You can work remotely, you can't live remotely. So what we're hearing too from developers is an awareness, developers that are building new product right now, they're not going to suddenly change all their plans to build home offices in every apartment, but they're going to cater to changing consumer demands. And some of the things that we've heard across our peer group is this, work from home is here to stay in some fashion. So high-speed internet connectivity into a dwelling unit is going to be critical. You might, if you're doing model units, for instance, at a larger property, you might certainly show some type of home office arrangement or a desk or have a laptop set up so that people can see where they can do some element of work in their apartment if they need to. And last but not least is package handling systems are going to become crucial because the retail shopping experience is changing dramatically, and you're going to see a real need to handle packages in a safe and efficient manner. So the forecast before and after numbers, and we're almost wrapped up. So as you can see, the forecast for rents year over year this year across the country, about an 8% effective drop. You're also seeing a 3% increase in vacancy. This is what we're going to add about 234,000 units to the housing stock in the US. So you are going to see, a choppy road this 12 months, which we're already experiencing. But the outlook beyond that is pretty favorable. The forecast for supply and demand, going forward from CBRE Econometric Advisors, you can see that, vacancy shoots up, but in 2 years, we're back to, let's call it normal. You're also seeing fairly positive absorption, dramatically improving in the second half of 2021 and carrying forward for the next 5 years. So if you have a longer view horizon, things look fairly favorable. And then just give you a little bit of flavor, how we change from how we compare to prior recessions. Our COVID, if you look at our purple line, if you will, we've had some fairly dramatic and significant changes in a short, relatively rapid period of time. but I also think that you'll see a strong and robust recovery. So that concludes our remarks. I want to thank the National REIA for inviting me to participate today.
Dave, we really appreciate it. And I know I promised you I wouldn't ask you any controversial questions, but I said I wouldn't ask from the chat bar. I didn't say I wouldn't ask you my own. So, you know, a significant portion of our members own more single family than they do multifamily. Some of us own multifamily, a decent amount of us own multifamily, but probably a greater focus in single family. Because of COVID and the idea of social distancing and the need for home offices, do you feel like that puts us a little bit ahead of the game in some ways, considering demand is still high, but maybe what we have to offer can be much more appealing at this point?
The answer is yes, absolutely. So, I mean, your people are going to want distance. I mean, in a larger apartment complex, for instance, I mean, we're going to see more demand already for, we're starting to see it for townhomes with a private entry versus a common entryway. Elevated high-rise buildings are going to struggle going forward. That's one of the big reasons of the movement from urban to suburban is I don't want to be in an elevator with a lot of people in this COVID environment. So carrying forward to your question, yes, where there's space, where there's separation, where there's elbow room, people are going to be wanting that. And so there's a prime opportunity for single family rentals going forward.
And you saw me cheering for the Midwest over here because we do kind of get the whole flyover state, look down their nose at us kind of thing. But I think we are really situated well for people that are fleeing the high density cities. Does that also hold true for kind of smaller towns at this point? Now that people are able to potentially work remotely, you know, we're having this conversation that some people really like that and some people don't. But if you have the ability to work remotely and you're fleeing a dense population, what do you think about heading into kind of secondary markets now, even more than growth in the larger markets?
Yeah, there's probably going to be some element of migration to secondary markets, but not probably not tertiary markets. So we've heard from you know, some of my peers in New York offices, some of the major companies, large employers across the U.S. They're going to start looking at their cost of living, the cost of occupancy in their office space, and the general cost of transportation to and from the office. So they're looking at some of these secondary markets. But the secondary markets have to deliver some level of an experience. I mean, you're not going to see Citigroup move 5,000 people to the tip of North Dakota. I have nothing against North Dakota, except it gets a little cold in the winter, and people might say, I know I can get a lot of house in the tip of North Dakota, okay, but I need something to do. I'm going to miss my Major League Baseball, and I'm going to miss the amenities and attractions. Or what am I going to do in this town when they roll up the sidewalk at 6 p.m.? So there's going to be movement to some probably secondary markets, but they're not going to stick people out in the middle of nowhere.
Of course, if MLB can't get their act together, we won't see baseball for at least another year anyway. So that's a whole nother rant for me. I know Charles had some questions as well. Charles, where are you?
Charles.
Don't make them too hard, I promise.
Charles on mute. Did someone mute Charles? Someone unmute Charles.
There's a lot of people that have wanted to mute me for a while.
I've never seen Charles on mute. Wow.
That's funny. Dave, so question for you, kind of along the lines of what Rebecca was asking. Even if you could go back, I think it's about 4 slides, the long year trend where you showed the loss and the vacancy rates. The question for you.
Let me try to backspace. Hey, I'm backspacing. Okay.
There we go.
Which one are you looking for?
Keep going. That one.
Oh, that one?
Yeah. So based on this, if we could separate out, I'll call them the A-class properties, the Bs, the Cs, and if there's a mitigating factor on vacancy and rent because of, I'm hearing this again more anecdotally,
Yeah.
but whether it's been with U-Haul or travelers or some of the different folks that are helping move people, there are people who are saying, I want my own one bedroom, and they're moving out from a roommate. The roommate's saying, I want my 2-bedroom because I have to work from home, so now I have an office. They're willing to spend more on their housing because the fear is whether it's a second wave or if this happens again, or I just want my space, which is causing a number of renters to actually move out and go to their own single family and putting more demand on the starter home market, which is quite frankly where a lot of our folks are doing rehabs and doing that. If that section of the market or that segment of the market looks a lot better than the overall picture here, so that, you know, the recovery on that side of it takes off much faster. The vacancy rates are actually not going to go up nearly as high as we might think. Again, we probably won't know some of that until well after July when the additional unemployment fees and dollars go away. But I'm wondering if it's really going to be as bad as that, especially for that market where you're talking people entry level coming in and expansion into kind of like we saw, I'll say back in 13, 14, it reflects a little bit on here, but folks saying, okay, I'm tired of living with family members. I'm tired of living with a roommate. I want my own place. And we saw a slow expansion of that through 13, 14 and all that. If we're going to see something similar to that because of COVID.
Yes.
So that's
Charles. Yeah. So here, great question. And here's this is my speculation. I think very likely that is going to occur. And it's going to be a two-step, Charles. I think once you have people back to work with some income security, okay, and they have a lay of the land, okay, hey, my furlough's over or my company reopened, okay, then I'm gonna go get my 1-bedroom or I'm gonna go get my 2nd bedroom. So I think that I agree that is very likely to happen, and that is going to follow, the return to work. People that are, if they're out of work right now or they're not sure what their employer looks like or where they're going to be. But I think that's going to happen. And I think that's going to happen over the next year as we get people back to work and the economy restarted this year. You're going to see that people execute that plan in 2021. And it bodes very well. I mean, you mentioned anecdotally, I've got friends that, kids, went off to the Big Apple to find themselves. Okay. Well, they've been up in this 300 square foot, what you and I call a closet. They call it a studio,
right.
And they're climbing and they can't go out. And it's like, what am I doing here? Like I never want to go to prison because I know what it feels like now because I'm stuck in this little unit. So right. Yeah, they're going to be, people are going to want more space. And, definitely I can see that happening. And I think it happens in maybe later this year, but certainly 2021.
And that's what I was going to say. Do you think that demand will stay steady and not spike until after people's concerns about second wave, whether they should be concerned or not? But do you think that those concerns might prevent the spike in demand that should have or could have happened, kind of waiting to see if that actually occurs?
Yeah, I mean, I think it goes back to the income certainty piece of, okay, we're getting back to work, doesn't feel like there's going to be a second wave. And because what you don't want to do is they go out and rent, moving out and getting that 2-bedroom apartment for that home office for my job. I need to be comfortable that my employer, Acme Corp, is going to have, is not going to shut down a division or something. So just getting the confidence and comfort level with some income security, job security, you will see those trends play out on a macro level. People needing more space, people looking for, and not everybody wants a roommate.
And one of the things that we talked about last meeting, Dave, and I'd like to see if you agree, is on the single family side is, we saw the luxury market has had a little bit of a tough time, or at least the move up market, because people have been staying put. But do you think after they've been staring at those four walls for a while, and now that they need a home office, those that have income will go ahead and move into those larger homes at that point? So our rehabbers maybe could be looking where maybe you didn't look at those larger homes to rehab at a point because maybe the market wasn't there. Potentially in 2021, people will start looking at that maybe.
Yeah, it goes back to the income security. If you can move up, there could be potential. If you start to see, the unemployment rate come down, GDP and payrolls are up and all that sort of thing, just at that level of an indicator, yeah, there's potential to definitely move up, get more space. The other thing that people look at from an investor standpoint is household formation. You can pull that census data down and get a feel about not only population trends, but household formation. If you want to really be clever and peel the onion, try to access some data on not just the birth rate, that's interesting, but the marital rate and the birth rate in a particular market will show growth in demand, which could lead to more housing. Because it's interesting, there's good opportunities in single family because, in my estimation, and a lot of developers would say this, the single family development market, okay, it still hasn't come back to the level where it was in 2008. I mean, so many small home builders and developers of product, they went out. So, that's why we've had a lot of growth in multifamily. One of the reasons the single family market has been so tight and not building to meet demand. So,
well, that's why we believe that maybe the opportunity could be really grand for our rehabbers. Is there's just not a lot of building going on. So if you can rehab and get into the range that's attractive for people, I think pre-existing home sales could really expand during this time. Of course, that's just me speculating. That it's not any kind of expert opinion.
The other thing, Rebecca and Charles, and I don't want to get out over my skis and above my pay grade, okay, but what I'm here on office space, okay, this is going to translate to single family and multifamily. Office space, the trend or need of the future is healthy space, healthy office space. So I talked about giving people more room, okay, pumping more fresh outside air. Those buildings take in 20%. The new standard is going to be 30 to 35%. I mean, they're going to start looking at some of these, what are the water supplies like? So that's on office. But I think there's some opportunity as people have some awareness of hey, I want social distance, but I also want something that's, healthy in some fashion, like not lead pipes, low VOC paint, things like that. I think it's going to be a selling point to some extent that you have or there's more natural light, putting in some windows, things like that to give it more of a healthier space feel.
Well, and Walt in the chat bar, I don't know if it went to everybody or just to me, but was saying if you're replacing furnace and AC, air purification equipment that is added onto that, those UV purification equipment that's on there is a real selling point, especially during all of this, after people have become so concerned about air quality. It could really be a huge selling point if you're doing that rehab and putting that on the home, adding that into the home at that time.
Yeah, I think there's definitely, opportunities. And I'm not saying you're trying to go full leads or full, complete eco lodge type thing. But certainly there's an awareness probably on the part of the consumer now or the buyer in terms of those lifestyle choices, which now there's a health consideration in there, at least in the back of their mind.
So we're heading into the end of the hour. Just really quickly, I know you keep your fingers on the pulse of kind of the finance market and as well. What are you seeing in terms of money being available?
Aha.
I know that's a whole presentation in and of itself. So I don't want to kind of lead you down too long a road, but just kind of quickly, what are you thinking?
Well, what's interesting is, as opposed to 2008-9, that the banks have not all fled, and they're not under duress to clean up their balance sheets, because generally speaking, the real estate markets in the U.S. were healthy. Back in 2007, the asset bubble was on the real estate side. The real estate markets now are healthy, so banks, they're not they're not kicking out every borrower that comes to them. However, you have to still be a solid sponsor. They're not taking risky deals. No one wants to, they're not going to stretch as much as they would have a year ago. That's from the bank standpoint. Fannie Mae and Freddie Mac, they're still lending, and they're, that's all fine. But there's, again, I don't want to get outside my skis. I don't do a lot of these deals, but there's so much equity out there looking for a home. I sense private money lenders, there's a lot of them, and they can understand the real estate piece. So banks are open. Just be prepared when you go in, and have a good story and a good track record.
Awesome. Dave, thank you so much for being here. We really, really appreciate you. I've told the group that if you don't mind, that we will share your slides when we share the replay, because people have been so impressed with the information and find it so valuable. So thank you so much again for being with us. We really appreciate it.
Thanks for having me. I really enjoyed it. Thank you.
Thanks, Dave. Charles, you got 10 minutes.
All right. I'm going to say, I'll keep this really brief for everyone. A couple of things. One thing, we've had a congressional hearing on housing, the housing recovery, evictions, the HEROES Act I mentioned in the past. This is in process. This is the House bill. Think of it as CARES 2. This bill has $100 billion worth of rental assistance in it. One of the comments, I love the quote, was frankly said, the cornerstone of the housing ecosystem is rent. And there's some truth to that, because if that rent domino falls, then all the rest of the dominoes start falling, including the values of houses that are nearby. The single families can't maintain. It starts putting substantial parts of the market underwater. So that's the conversation at the federal level in Congress. They are having this discussion. They're talking about it, trying to make sure that rental assistance does come forward so that people are paying. So as you get anecdotal stories, if you get statistics, please share them with us. I need that information. I need those anecdotal stories. Whether it's somebody who was able to lost a job, survived for a while in unemployment, got back and going, whatever the story is, I need those stories. So please share them with me. Send them to my email. Lori will post that email up there in just a moment, charles@nationalrea.org. The other thing I want to mention is, in some areas, Arizona and Florida right now, we're hearing, potential second wave. We're hearing about PPE requirements in Florida, or excuse me, in California, mandates. There's a few other smaller areas that are getting mandates. Folks, that's going to come and go over the next several months. Hang in there for it. Be ready for it. Have PPE, which is personal protection equipment. Have some ready. Have some ready for your staff. Make sure that if you've got contractors, they're utilizing this. There are some areas that, we forget about all the masks and all that stuff. Other places, it is absolutely mandated. So make sure you're prepared, because if things spike in your area, you may see a whole change in the rules very quickly. So make sure you've got, redundancy built into your system, things ready to go, and just be prepared for it. The final thing I'll mention is with PPP, again, the Payment Protection Program that came out, and folks that receive funds from that, if you receive funds, it's time for just the starting window is open, to put it that way, as far as forgiveness. So get ready to start putting those in there. You're going to see more from us on forgiveness and different things. There's more flexibility on it. Instead of having to spend 75% of it on employment and payment, you can actually be lowered down to around 60%. So there are options on that. Now, one of the things we're hearing, and this is just as you have people who are working and they're living in your property and they're paying rent, and you think, oh, they've got a great job at a big company. There are some of these companies that have taken funds, and now what they're doing is they're trying to downsize their employment numbers, but they don't want to show that they're firing anybody. So they're trying to move people around, and in moving people around, they're getting rid of people. So they're reducing their employee count, but not because they fired anybody. So be aware of that. Don't, just because you got people working for, what are quote unquote good companies, doesn't mean they're not going to get downsized. We're seeing this in the medical departments, especially like across the board in the medical field. That is coming across because of the impact of COVID that was, because of all the elective surgeries they couldn't do, quite frankly. So just bear in mind, keep the communication going with all your residents and keep finding those properties, walk the communities, find out where they're at, because there's going to be a demand for those single families, especially in that starter community. There's a demand out there for it. So that's pretty much what I have right now, and there will be more coming. Rebecca, back to you. Under 10 minutes. How's that?
Awesome. That's terrific. Also, just wanted to remind everybody to stay in touch with your local attorney on the eviction side. I know many of us are dealing with challenges there. I know Jane in Chicago has just had horrible problems. I think they're getting ready to sue. I know Kentucky's potentially getting ready to sue the governor. Colorado,
New Jersey.
I know you were working with Troy on the Colorado issue where they were trying to hold, they actually proposed potentially a year, and that's just insane. So I don't know if you want to give any updates, but certainly stay in touch with your local eviction attorney on that.
No, it really is that, Rebecca. It's some of it's state level, some of it is county level. Make sure you're staying plugged into what the laws are, what the rules are. Some places you can actually give a notice to a resident. Other places you cannot even give a notice to a resident. So make sure you're complying with those laws, because if you gave a notice, are relying on that, and then when the court opens up, you go in to apply, but you weren't allowed to put the notice up, now you got to start over again. So, let's not waste a lot of money and time. Pay attention to what those laws are. And at this point, I haven't seen anybody at the national level trying to say, here's what's going on across all the places, because honestly, it's changing so dramatically, so quickly, still in so many areas, it's hard to keep up with. So please, that's where follow with your local REIA. They're plugged in, work with them, and your local eviction attorneys.
And on that same subject, guys, we had a panel with our eviction attorneys. And of course, as I know Charles know, but maybe if you don't live in Florida, you don't know, that our moratorium was extended again until July 2nd. We're obviously a lot of landlords sitting on pins and needles waiting until July 2nd comes around. But I would just say, state to state, expect that there might be delays when they say, okay, this is the date the moratorium is going to be lifted. That doesn't necessarily mean it's set in stone.
It may get pushed back still.
Nothing's set in stone right now, right, Charles? Yep.
Okay, sir. Take us home.
All right, guys. Well, I want to thank everybody for joining us today. Everybody have a great weekend. Our next call is going to be on July the 17th. Of course, this call today will be recorded. You can always go to nationalrea.org and see all of the updates there, reminding you guys that we do have COVID-19 updates as they come in. Charles and his team working diligently on getting those to us, and we get those updated on the website as they come in. But we'll see you guys on July 17th. Everybody have a nice weekend. Thank you for the team, and thank you to Dave Lockard also today as well, our speaker. Have a good one, guys.